Hello everyone, this is Sebastian McMahon from IA Financial Group. I'm back with the weekly review, this time for the week ending May 24th, 2024. So a very interesting week. The theme of this weekly review is that the door is open for the Bank of Canada for rate cuts. We'll dig into the details, but before we get there, it was an interesting week. We've had some more confirmation that the global manufacturing cycle is getting better. We got the global PMIs that are majoritarily going higher, so good news there. And last week, if you remember, we're mentioning that optimism was reigning over Wall Street. Well, you kind of have these two forces. There's a lot of optimism, which eventually becomes kind of a headwind for the markets. It doesn't mean because optimism is high that it's a selling signal. Not at all, but it just means that the marginal buyer is already in the market, so it could be a headwind. And on the other hand, we have the macro data that is getting stronger and stronger. That gives you a market that is kind of stuck between the two forces here. Could have some short-term volatility, some consolidation phases, some false starts. So we're pretty much in this kind of environment. This week we had some volatility. The market was strong at the beginning of the week, got weaker as the week progressed. Commodities were pretty volatile. So we're in this kind of environment here. And of course, we're heading into a summer where liquidity is lower in the markets. So expect some more short-term volatility here. But if you look at the markets at the close on Thursday, so pretty quiet on bonds. But if you look at equities, as I said, we started the week strong. We were weakening as the week went by. TSX down 1.15%, S&P 500 minus 0.65%. We got the earnings from the mighty Nvidia this week, again, just through the roof. So very strong earnings. So the markets cheered that, but they cheered Nvidia. We're still seeing a sell-off in other parts of the market. So Nasdaq is higher on the week. EFI, emerging markets, a little bit lower here as well. Commodities were pretty busy this week, minus 4% on oil, minus 3.6% on gold. Copper also had a tough week. Interestingly, we started the week at record highs or close to record highs for gold and copper. And then we had a strong drawdown during the week. So markets, again, after such a run for commodities, gold, copper have had gains of 40% plus over the last quarters. So when you've seen stuff like this, it's completely normal at some point to have some volatility, some profit taking. So we still think that the macro data is supporting the price of commodities like copper for sure. But in the short run, of course, you should expect at some point to have some profit taking happening. So it was one of those weeks. As I'm recording this on Friday morning, price of gold, price of copper seem to be recovering a little bit. So we'll see if the worst of that is behind us. Now looking at Canadian data on inflation, total CPI at 2.7%, falling slowly. It's because of the weight of shelter. We'll discuss that in a few minutes. But core CPI on the right, and here I'm using the old Bank of Canada measure, the one excluding the 8 most volatile components. So it adjusts for shelter, and this one, or at least part of shelter, mortgage interest costs. So we're at below 2% on the inflation there on core. And if we look at the next slide, well, shelter inflation, as I said, remains pretty hot at about 6.5%. But if you take away shelter from the total inflation, you get something that is very close to 1% now. So thus the narrative that it's time to move. And again, shelter inflation is about 30% of the CPI basket. So it's a very important component. But the Bank of Canada cannot do anything about it. That's the point. It's demographics that are pushing that, and interest rates are too blunt a tool to help shelter inflation. It's more about what we can do on the fiscal side of things. And also, when we have population growth that is as strong as what we're seeing now, well, of course, there's going to be some pressures. So you're not going to keep rates elevated for too long, and just choke the Canadian economy just to try to accommodate that. It's a lost cause. So when you look at total X shelter, it's time to move. So we think that a rate cut is coming. likely on June 5th in 2 weeks. if not on June 5th, pretty much assuredly on July 24th. These markets are pricing that in. If you look at what market is pricing, it's about 63% odds of a June 5 cut. We think it should be a bit higher than that. But also what that tells us is that if we do have a cut, markets should react, so rates should fall because it's not completely priced in. And again, interestingly, fixed rate mortgages, now the rates on the fixed mortgages 5 years have already fallen from 6.5 to 6% on average based on the data from the Bank of Canada. If we have a Bank of Canada that cuts and sends the message that more cuts are coming, we could see more pressure lower on interest rates, and fixed rate mortgages could also become a little bit cheaper as we move forward throughout the year. So that could give a breath of fresh air to borrowers here. By the end of the year, it's about 2.3 cuts that are expected. We think it's more likely to be 3 or 4, so we're in the more dovish camp here. So Europe coming out of recession, as I mentioned, the manufacturing and services data coming out are again showing how the global economy is rebounding, but especially in Europe. We're seeing services, we're seeing manufacturing rebounding. The chart on the left is telling us that we did have a recession in late 2023. Q1 2024 is when we came out of recession, and the latest data is confirming that the trend is continuing. So we always see the global economy as a tripod. You have China, the Eurozone, and the US, the 3 biggest components of the economy. As long as you have 2 out of 3 that are doing well, the economy should be fine. The US is doing very well. Europe and China, they are rebounding. They're not, out of the woods yet, but they're rebounding soundly. So things are looking on the up for the global economy. What we'll be watching next week, Q1 GDP should be up 2% in the first quarter. Conference Board consumer confidence should be a little bit lower in the US. Q1 GDP revision, we had 1.6% on the first print, should be revised lower to 1.2, and the core PCE inflation should be stable at a level that is still a little bit too hot for the Fed, so don't expect anything market moving there next week. So it's always a pleasure to serve you. If you like the content, please share, and of course, come back again next week.